In this session, we will explain the concept of non-deliverable forward contracts. By the end of the session, you'll be able to define the key characteristics of a non-deliverable forward, illustrate how an NDF could be used, and calculate the settlement proceeds of a non-deliverable forward. Without wishing to sound my age, I suspect many listeners assume that buying and selling currencies freely is a very easy thing to do. However, this is not always the case. Some countries might impose restrictions on the convertibility of their currency that could take different forms. For example, it might only be possible for non-domestic participants to trade in the spot market, and then only to support an underlying trade transaction. It might also be the case that two foreign banks cannot deal with each other directly in the domestic currency. Yet another reason could be credit concerns. As a foreign bank, you may decide that dealing with a domestic bank carries an unacceptable level of default risk. So what is convertibility? It refers to the right to freely convert a national currency at the prevailing exchange rate into any other currency. The International Monetary Fund applied three standards to determine if a currency is convertible. It can be used for all purposes without restrictions, exchanged for any other currency without limitations, or exchanged at a given rate, either fixed or floating. It is common for participants to differentiate between hard and soft currencies. Although there are no strict definitions of what constitutes a hard currency, they would include dollars, euros, sterling, yen, and Swiss francs. Soft currencies are characterized as being volatile, perhaps being issued by a politically and economically unstable country. The country might have high inflation, and that the currency is perhaps prone to depreciation. To illustrate how an NDF might be used, let us set an example. Suppose a dollar-based investor has bought 100 billion Korean won of a 2% 10-year Korean treasury bond. As an aside, where the amount of a dealt currency is in the billions, it is often referred to as a yard. The investor will earn half the annual coupon in 6 months' time, which will be 1 billion Korean won. If the investor anticipated converting the proceeds into US dollars, they would have a foreign exchange rate risk. So what are their options? First, sell the cash flows in the spot market when required. Second, sell the cash flows on a deliverable forward basis. Third, sell the cash flows on the spot market, but hedge the change in the foreign exchange rate with a non-deliverable forward. The risk of doing nothing and selling the cash flows in the spot market means the investor is exposed to a depreciation of the Korean won and therefore an appreciation of the US dollar. Suppose that the current spot rate is $1 will buy you 1,300 Korean won. The 1 billion Korean won coupon cash flow would therefore convert into $769,231. If the exchange rate moved to $1 equals 1350 Korean won, which would represent a won depreciation, the dollar proceeds would be reduced to 740,741. Admittedly, the opposite could also happen in that the won could appreciate, increasing the dollar income. In this scenario, we will look at how the investor could hedge their FX exposure using the NDF market. An NDF is a cash-settled short-term forward contract on a thinly traded or not fully convertible foreign currency. As we showed in the forward module, a deliverable contract will involve the movement of both principal amounts. But in the case of an NDF, the cash flows at the settlement date are based on the difference between a pre-agreed exchange rate and an applicable spot fixing rate. This means that the NDF is classified as a contract for difference, whereby only a single sum of money is paid in US dollars and there is no cash flow settlement of the counter currency. However, since these contracts are individually negotiated, it is possible to have settlement in a mutually agreeable currency. So an investor enters into a forward agreement to purchase or sell a notional amount of the base currency, which would be dollars in this case, at the contracted forward rate. They would pay, or receive, the notional amount multiplied by the contracted forward rate of the quoted currency. On the fixing date, the investor would theoretically be able to sell or buy the notional amount of the base currency at the prevailing spot rate, earning or paying the notional multiplied by the spot rate of the quoted currency. This means that the profit or loss on this trade in terms of the base currency can be expressed using either of the two formulas on screen. First of all, it could be the notional multiplied by the spot rate minus the forward divisible by the spot rate expressed in the base currency. The alternative is the notional multiplied by 1 minus the forward divisible by the spot. So how would an investor decide as to which currency they wanted to buy or sell? Well, if you expect the non-deliverable currency to weaken relative to the settlement currency, sell the non-deliverable currency, buy the settlement currency. Expect the non-deliverable currency to strengthen relative to the settlement currency. Buy the non-deliverable currency, sell the settlement currency. The quoted contracted forward rate is based on the interest rates that prevail in the respective markets. This should follow the principles outlined in the previous forward market module. However, there may be a difference between the deliverable forward rate and the NDF, perhaps due to the cost of hedging the bank's own market risk. Using the same scenario presented earlier, we'll suppose a maturity of 6 months, where the reference currency will be Korean won. The notional amount will be a yard of won. Settlement currency will be dollars, which would give us a settlement currency notional amount of 778,210, and this has been established using an agreed forward rate where $1 equals 1,285 Korean won. When trading a non-deliverable forward, the contract will state the source of the reference spot rate used to settle the contract at maturity. This spot rate will be a snapshot of the underlying market and could be determined by some official institution such as the local central bank or a local association of banks. Jumping forward in our time machines, let us consider what the outcome will be at the 6-month settlement date. In the first scenario, we'll have a look at a situation where the won depreciates to 1,350. The investor receives the 1 billion coupon, which it sells at the prevailing spot rate. The 1 yard of won generates 740,741. But under the terms of the NDF, the investor will receive 37,469 from the bank, and so their proceeds will be 778,210. We can show how the settlement amount is calculated using the formula presented earlier. We take the agreed notional amount of 778,210 and we multiply it by 1 minus the contracted forward rate divisible by the spot rate at maturity, and that returns our settlement amount of 37,469. In our second scenario, we'll have a look at a situation where the spot rate appreciates to 1,250. The investor receives the 1 yard of won coupon, which it sells again at the prevailing spot rate. This time, the won generates 800,000 US dollars. To settle the NDF, this time the investor has to pay 21,790 to the bank, which is the difference between the spot proceeds and the agreed amount locked in by the forward. This ensures that the net proceeds from the spot sale and the NDF settlement totals 778,210. As before, we use the formula to illustrate how the NDF is settled. we take the 778,210 and we multiply it by 1 minus the pre-agreed forward rate divisible by the spot rate at maturity. Here we're going to see a negative amount of 21,790. So as an aside, we can see from the formula that if the spot rate evolves to equal the contracted forward rate, there would be no settlement at maturity. So what are some of the key takeaways? Not all currencies are freely convertible, and so an NDF can be used to facilitate hedging of an FX exposure. It can also be used for speculative purposes to express how a currency rate is expected to evolve. A non-deliverable forward is a cash-settled contract for difference, usually settled in US dollars. Like any forward contract, it offers the investor cash flow certainty.